Hey, it's Kristi. Thank you so much for being with me for another video. This one's going to be a little bit different than what I typically put out there, and it's going to be just an overview of a basic credit and budget class that I have taught recently. I got to teach just a few nights ago, and if it wasn't at the end of a 12-hour workday, I would have come home and just recorded it right away because in that moment it felt so good when I got to actually see somebody get it for maybe the first time in their lives. So I wanted to share this with you. It's probably going to be longer than some of my regular videos, but an overview, and it all starts with mindset. So that's where I wanted to start. It was 2 hours of being very interactive, and so I'm really going to shorten this down, but it's so important for a couple of takeaways before we can start talking about credit and start talking about budget. We really have to get to what's underlying for each of us, and it's very, very individual for each of us as well. So I'm going to talk about our core story. I'm going to talk about money mindset. And then we spoke about some credit basics, just having a really great understanding. And then also the elements of a budget and what makes it so difficult to budget. So let's dive in. When I had introduced myself, I'd never met these ladies in the classroom, so I shared a little bit about me, and so I'll share a little bit about me. I have been a mortgage loan officer for 10 years. I was also a short sale negotiator for 4 years, which meant I was helping people get out of the homes instead of helping them get into the homes. And I got to help hundreds of families avoid foreclosure through the short sale process. And I have helped hundreds of families buy their first home and their next home and even save a lot of money through refinances. So part of what I do as a mortgage loan officer is I analyze the financial picture for a person or a family. And that includes analyzing credit. I have looked at thousands of credit reports, and I see some consistencies with some people, and it's not necessarily just the way they were raised. It was like our society has kind of created a payment-driven group of people, if you would agree. I mean, you can finance your cell phones at this point. There's not much that you can't finance. So when I'm looking at a credit and financial picture, I'm looking at somebody's ability to get approved for a mortgage loan. But in the last couple of years, it's really hit me. I need to look at it more holistically and look at the entire picture of where this is going to have this person or this family in 10 years, in 20 years, in 30 years, and help them make a better, wiser financial decision and have a better understanding of money. So I started off with that. I think the most important thing that we can do right now is to understand that we have a core story when it comes to money. So what does that mean? Somewhere in your formative years, so it was probably when you were around 4, 5, 6 years old, you started becoming very aware of money. And it wasn't that your parents or your caretakers sat you down and taught you, this is why I go to work, this is when we pay the bills, this is how much we have to work with. It obviously didn't go like that. And you may have gotten some financial lessons from some money mentors through your life, but for the majority of us, we were not blessed that way. So when you were somewhere around 4, 5, 6 years old, you were seeing how your parents behaved with money. Were they constantly swiping a credit card? Were they constantly fighting about money? Did it always feel like there wasn't enough? Or did you live in the lap of luxury only to find out years later that your family had borrowed all of it? I've seen some people have tens of thousands of dollars of debt and have to go into a state of bankruptcy. So if I was going to get honesty and connection with my class, I had to be very honest about my core story. So I was raised in a household where we were really broke. Notice I didn't use the word poor. Words have power, and we were not poor, but we were broke. My dad was a pastor, and he was also a principal of a Christian school. My mom had a daycare because what do you do when you have 5 kids? You just bring in more. And my parents took in hundreds of foster kids during the first 8 years of my life. We hosted missionaries as they traveled around the country, and I saw my parents give and love so deeply and so much. But it turns out later in my life, and I didn't realize this until just the last couple of years, that I had a core story when it came to money. And my story was I could do good in this world or I could make money, but I couldn't have both. And you guys, nothing could be farther from the truth. I can do good in this world and I can earn a living while doing so. But I was stopping myself short. I found myself stuck all the time when it came to money. Just 5 short years ago, I was working 3 jobs. I was working as an executive assistant for a business owner on the other side of town in a warehouse district. I was working at a jewelry store in the mall for 24 hours over Friday, Saturday, and Sunday every single weekend. And I was transcribing at night for way too little of money, maybe $8, $9, $10 an hour, just to make ends meet. I had a really big desire to buy a home, and so I had to hustle and make this extra money to make it happen. But I also didn't understand that there is a time value exchange when we go to work. So most of us show up to a job that we don't really love and we don't get paid well enough to do it. And so it kind of seeps into the rest of our lives that we're not really happy or fulfilled or earning the kinds of dollars that we're capable of earning. So I started seeing inside of myself, what do I need to do to step into my space, my greatest attributes to the world? The best investment you could ever make is in yourself. So how do you know more about this one thing that is your passion or your industry or your specialty? So that way you can get paid more for it. And when you're exchanging your time for your money, you're fulfilled, it's enough, it's what you desire to earn. So we started off with that foundation, and I said, please take some time over the next few days. And it was really difficult, I know. And it's going to be difficult, I know, because I was speaking to very, very busy ladies. They're single moms. They have a couple of kids at home. They've got a lot going on in their lives. But it is so important to start uncovering your core story of what you believe to be true about money. I know that there are people that use money for leverage and for control and for manipulation. And I know that there are some people that have some twisted views about money. And money can be the biggest stressor in one's life if you don't have enough. And if you have enough of it, you learn that money is a tool and you can use it to generate even more money. So let's start at what your core story is, because your core story has created this relationship with money, and there's a really good chance you don't have a really great relationship with money. So let's start with the core story. So when I was sharing from the heart, I said most important is God, second is family, and third, let's face it, it's money. Not the love of money, the have of money. Let's face it, we have to have money to have a roof over our heads, to have the light bill on, to have food in our tummy, to have those things that really bring us a lot of joy in our life. It usually costs money. So how come we don't spend enough time learning about it, understanding it, how to work and live inside of our means? So many people get out of high school or college and they just want to go and live like a CEO, but you're not earning the income of a CEO. You'll get there, but we have to start. You don't have to be 21 years old driving a $50,000 car. I promise you, the world does not see you through the windows of the car that you're driving. It doesn't bring you any more value. You bring your value. And when we start understanding that and how to live inside of our means, how to pay ourselves first and have that savings generated, go and earn more money on our money, that's when we can start to build wealth a little bit later in our lives. So at this point then, I shifted over to talking about credit. And credit is not taught. You might know at this point that I also have a podcast, and it's called Credit Coaching by Kristi. All I talk about is credit. And so I invite you to go over there if this part of the conversation is important to you. So let's talk about credit. Anything that reports on your credit report that is something that you have borrowed money for, it is called a trade line. We refer to it as a trade line, and there's 2 different kinds. There's a revolving and an installment. So let's start with some basics. A revolving is a home equity line of credit, or it's a credit card. So most of us understand how credit cards work. You have a limit that you can use up to, and you have a balance, which is whatever you have on your card at any given time. And your minimum monthly payment is based off of what your balance is at the time of your bill cycle. So if you borrow money against your credit card and you pay it off prior to your due date, you don't owe any interest at all. If you have a very low balance at the time, your minimum payment's likely just going to be $25 or $30. If you have thousands of dollars, your payment is likely going to be hundreds of dollars. And I need for you to know that most credit cards start somewhere at around 11.99, and it's based on your credit rating. So if you have excellent credit, you could probably have a very low APR on your credit card. But most people have somewhere between a 16%, and store credit cards go up to 29.99%. It's insane. So let's just say that the average credit card has an APR of about 19%. It will take you years and years and years if you pay that minimum payment to pay down that balance, because the majority of your payment goes to paying interest. And if you look at your credit card statement, look at what you've paid in interest over the last 12 months. It might make you a little upset to your stomach, and I actually hope it does, because I want you to pay off those credit card bills. Now we'll shift over to what an installment loan is. A couple of examples of installment loans are personal loans, student loans, a car loan, and a mortgage. And what's important to know about an installment loan is that it has a daily interest charge. So let me explain what that means. An installment loan is an agreed upon amount. So you've got a set dollar amount that you started off with borrowing, and it's over a set period of time. So let me give you an example. A mortgage might be paid over 30 years. Student loans might be paid over 10 years. And your auto loan might be paid over 5 years. So how that works is you start with the amount that you've borrowed, with the amount of time that you have agreed to, and there's an interest rate. Typically, this interest rate is a fixed interest rate. It can be an adjustable, but for the purpose of this conversation, let's just say it's a fixed interest rate. So what happens is there's a calculation based off of that fixed interest rate that creates a daily interest charge. So that means every single day that you are borrowing, it is accruing interest. What's important to know about this is that even if you pay extra or early, your payment is likely still going to be that original amount that loan had started off with. So let's say your car payment is $350 and this month you paid $500. It doesn't mean that next month you owe less. It does mean that next month you still owe $350. What it did do though is it shortened that 5-year term a little bit. So I want to teach you right now that if you pay even a day early or $1 extra, it shortens the length of that term of how long it's going to take you to pay that off. So when you're in a position to pay a little early and a little extra, please do it. I created a video on my YouTube channel about bi-weekly payments. A lot of student loans and car loans will let you do this, but almost all mortgage companies will allow you to do this. And this will help shave years of interest off of your loan obligation. So I encourage you to watch that video. Perhaps I'll make it an end card at the end of this video as well. So now that we have a basic understanding of what revolving and installment are, that's what's reported on your credit report, along with some other information, your personal information, inquiries, payment history, all that kind of stuff. If you'd like to know more about what makes up a really great credit score or how to improve your credit, I do invite you to that podcast where you can get some more information. What makes a solid credit report is having at least one installment loan and at least one revolving account. Having a whole lot more than that isn't going to help you so much. I will tell you that having a mortgage on your credit and paying it on time will really do great things for your credit score. And for your revolving accounts, I really want you to get this lesson right here. Keep your balances 30% or below of your limit that is allowed to you. If you use greater than 30%, the credit reporting bureaus view that as an overutilization of credit. So I do encourage you to keep the balances low. And if you want to avoid interest fully, pay it before that due date comes and you don't owe any interest. So it's usually about 25 days since your last due date. I was asked if it was a good idea to have a 0% transfer for a credit card if somebody has a really high interest rate. And if you have a good enough credit score to be offered that, then I would absolutely say yes, but it's a trap. Hear me, listen, okay? A lot of the small print on those credit cards, you've got to read it in advance. So let me tell you what most of them say. So I just looked at a really big bank that is issuing one that is 0% for 18 months. It sounds extraordinary, especially if you're paying 19% on your credit card currently. So here's what I need for you to know. It usually says it has to be done within 4 months of that offer date. So make sure that it's done right away. Get that amount over. It's usually somewhere between 3 and 5% of your balance that you're transferring. It's worth it if you are paying in the teens or in the 20s on an interest rate. If you make any purchases on that credit card that you move that balance over, those purchases are going to be at a really high APR, probably likely in the teens or the 20s. So try to avoid using that credit card for any purchases at all. Just bring that balance over and then don't use it for gas, groceries, anything, because what's going to happen is every time you make a payment, it's going to go to that 0% because that bank isn't making any money off of your 0%. And then it's going to be accumulating this interest up here on your purchases. So don't use it for purchases. Don't use it for a cash advance. Most of them charge about 25% on the amount that you used for a cash advance. So just cash advances are no-nos on your credit card. You got me? Okay. You have to pay that amount off in full before the end of that term. A lot of these credit cards, like those furniture stores and the 0% on the bank issued credit cards, will charge you the interest that was accumulated on the entire original balance, even if you had $2 left at the end of that term of that 0%. So it has to be paid off in full by the end of that term, or you're going to wind up paying an excruciating amount of interest at the end. It's not worth it at that point. And so we rely on this credit card to get us through our gas, our groceries, our bills. And so if you go and transfer this balance over to the 0%, then you're likely still going to use the original credit card that you move that balance over. And now you've got 2 credit cards with balances on it. And so that's where I say it's a trap. If you're going to do that, put everything into what you've got to pay off that 0% transfer so it's paid before the end of that term. But we have to modify some behaviors. Would you not agree that if you wanted to lose weight, you have to modify some behaviors of what caused that weight gain, which is typically not working out and not making really good decisions on the kinds of foods that we put in our mouth? And it's the same way when it comes to our finances. You're going to have to smoosh it down just a little bit. So here's what I taught. There are 2 ways for cash flow. Are you ready? Spend less, make more. That's the only way to have an improved cash flow. You've got to spend less and you've got to save more. So a lot of us can really skim off the top. We've got our monies going to some different places. If you're used to getting pedicures and dropping $40 every time, paint your toenails at home for a little while until you accumulate some extra money to pay off that debt. Instead of having Uber Eats, go pick up the food. Better yet, cook at home and save some money. See where you can slice, but I know that you can only get to a certain point of slicing from your budget, right? You still have to have the heat on. You still have to have, Wi-Fi. You can't get rid of some things completely. I get that. So maybe you need to consider a side hustle. There are a lot of places that are hiring, and you guys, it is not forever, okay? So don't let your ego get in the way. I can't go and drive Uber. I was transcribing for $10 an hour these interviews that were going to be turned into commercials. I'm not too good for anything. If I need to pay some bills, I'm going to find a way to do that. And I encourage you to do the same thing. But make sure you're giving yourself permission, okay? It's just temporary. It's to help you to accomplish a really big and important goal. And if your goal is to get out of debt and have a better understanding and a better relationship with money, sometimes you have to make a few sacrifices, and just know it's not forever. Okay, so we talked for a few minutes as well about collections. So there's medical and there's non-medical. And guess what? This is what hurts. They hurt the same. It doesn't matter if you have a collection for a $10,000 credit card balance, or if you have a $50 medical collection because you just didn't know that your copay didn't cover this one part with the doctor. A new collection is a new collection. I actually want to lobby to make that change. I think medical collection should not hit the same way as just, mismanaging money or not being able to pay some outstanding debt that I agreed to, I signed for and said that I would repay. But for the moment in time. A collection is a collection. Now, when it comes time for a mortgage, we don't hold medical debt against you as far as collections, but it still has an impact on your credit. So if you have a lower or damaged credit score, you're going to typically pay a higher interest rate on that loan. I was speaking to a young lady yesterday. She has a really high interest rate on her current mortgage, and I was so excited at the possibilities of being able to slice it down by potentially 3%. And the more we started talking, the more I realized, we've got some credit issues here. So she starts sharing with me about where she's at with her credit, her behaviors. So we had to talk about some behavior modification. But right now she's paying a very high interest rate on her mortgage. Her insurance just went up a lot. I'm not quite sure if she made an insurance claim or what happened there, but it went up like hundreds of dollars a year. And then on top of that, she's got a really big auto loan payment. So she wanted to see if she could roll that into her new mortgage loan. I found out she's paying 17% as an interest rate on her auto loan. Her payment is through the roof and she's really stretched and struggling. She's paying 17% because she has a really low credit score. And unfortunately, with that low credit score, I can't put her in a better position for her mortgage loan. So do you see the impact that your credit score has? So think about this. Your credit score impacts rates when you go to borrow money. So for a mortgage, your auto loan, your credit score also determines interest rates on what credit cards are charging you and also what's even available for you. If you have a low credit score, there are some credit card companies and some mortgage companies that just cannot and will not loan money to you. When it comes time to start utilities for water and electric at your home, a lot of times those utility companies will pull your credit to determine what kind of deposit they have to take from you. Insurance companies, your auto insurance and your homeowner's insurance is also based off of what your credit score is. It's so important that you have a basic understanding about credit because it will cost you tens of thousands of dollars more over time if you don't get that under control and improve your credit score so you can improve your interest rates. Okay, so now let's shift over to a budget. Why do you think most people don't follow a budget? Why do you think most people don't even create a budget? All right, so I'm going to break this up into two different sections. Most people don't follow a budget because it's really difficult because of the way that we pay, right? So we've got auto drafts and auto pay for those fixed costs in our lives. So maybe your mortgage and or your rent is just drafted out at the first of every month. And maybe your auto loan is drafted out every month when it's due automatically. So we've got these set things. It's kind of set it and forget it. We've got fixed costs and we've got those variables. And those variables change so much. So it is January at the time that I'm recording this. So you would agree that in December, you probably spend a lot more on your gift giving than you do in, say, March, right? Speaking of March, your electric bill is a lot different in March than it is, say, in January when you've got the heat on every single day. So we've got those variables in our lives that cost us different amounts throughout the year. In addition, what about all of those little surprises that come along, right? You have an emergency medical cost. All of a sudden you have a tire that blew and you have to replace your tire. So I could go on and on with examples of what surprises might come your way, but you get it, you live it, I don't have to tell you. So this is not the devil. This is not even a budget. A budget for most of us feels like you're telling me how I can spend my hard-earned dollars. And I'm telling you that we need to rephrase and reframe how we view that little piece of paper. So let's call it this. Let's call it a tool in which you can manage your money. Because if we don't look at it that way and we don't follow a budget, your money is managing you. It caps you on what you can do. It strips you of the ability to save the way that you want to. It takes away a future that is something that's worth getting excited about because you're not putting money towards your retirement accounts. And let's face it, if you're paying hundreds of dollars every single month towards interest on credit cards, on your mortgage, on your auto loan payments, that's money that's using you. So I want to reframe that into something that feels a little bit more empowering, okay? I want it to look like a management tool where you are the boss of your money, that you tell it where to go. But in order to do that, you've got to see what's actually coming in and what's actually going out and then make adjustments for that. Could you imagine if Fortune 500s, the S&P 500 companies, or even a local mom and pop shop or a nonprofit, could you imagine if they didn't have a budget that they followed, right? They've got marketing dollars going over here and payroll dollars going over there. It could potentially keep them from being able to meet payroll or to have any income at the end, in which their stakeholders and their shareholders get really excited and they're able to pay everybody, right? They're able to sustain and stay in business. So much like a business or an organization has to follow a budget, you have to follow a budget as well. So I want to share with you a couple of tips that I do without getting specific into the budget itself. First and foremost, you have to pay yourself first, okay? You are the one working hard for your money. You need to reward yourself with some money. So before anything else, you need to set up a savings account that is separate from your checking account. When I say separate, I mean totally different bank, right? So in my bank, every time I log in, I will see all of the accounts that are my accounts listed there. I don't want to see what I have in savings. Savings should be separate. So I have my savings in a full different bank than where I do my checking. My checking I refer to as my operating expense. So that's where money comes in and money flows out to my bills. But before I start even working with my take-home pay, I have set it up with the payroll company that 10% of my take-home pay goes over here to my savings account. I don't even want to see it. So it's forcing me to live off of the 90% of my take-home pay. And I'm telling you, you can do this. You can make adjustments. You can do this. And I know right now you're screaming at me saying, but Kristi, you don't even know. I can't even make ends meet as it is right now. And you're telling me I've got to try to shave 10% off the top before I even get started? Yes. If you're looking for an extraordinary book, a financial quick read that will absolutely change your life, read The Richest Man in Babylon. And as soon as you read that story, start implementing. But one of the very first lessons is pay yourself first. So put that 10% over into a savings account and you will figure out the rest. I promise you, I've got you, I'm telling you, you will be able to make this happen. So you put aside the 10% and that's going to go towards your future goals. So we'll circle back around to that for just a moment. Then I want you to, on a budget, write down all of your fixed costs, right? That's your rent or your mortgage. It's your auto payment. It might be your Wi-Fi bill, a cable bill. My cell phone bill is always the same every single month. So write down those things that are fixed costs. Insurance tends to be the same every single month. And then write out all of your variables. And you guys, if you want to, hit me up. I'm happy to give you a basic budget where you can go in, and keep in mind it's going to change every single month. So if you wind up paying $300 for electricity in those months that you're using the air conditioner or the heat all the time, and it's $100 when you get to have the windows open and the ceiling fans on, maybe use an average of $200 for your first budget just to get your toes wet in the water. Then start seeing where you can cut, where you can kind of slice back, and if you still have such an outflow that gives you a reason as why you're constantly using your credit cards and why you constantly have a balance and why you constantly are not in a position to be able to pay down that balance, as soon as you pay a big chunk down, you wind up putting another chunk up. Here's the problem. Life is full of surprises, and sometimes it's not the fun ones. Sometimes it's the costly, expensive ones. But you can't say you didn't see it coming because life is full of surprises. So you have to expect the unexpected and at least prepare for as much as you can. So your very first goal after setting up your 10%, going into a separate savings account at a separate bank, is work towards having a cash emergency fund of $1,000. And as soon as you have that, reward yourself with something really special. Go to get some ice cream, go treat yourself somehow. Once you get your $1,000 in that emergency savings account, your next goal is to get to $3,000. And I'm telling you right now, you can do it. You'll find ways to get there. You'll create the hustle. You'll take on a part-time job. You'll sell stuff. You'll figure out a way to get there. You've got to modify the behaviors. In anything in life, we have to change it. Think of a 5-year-old having a tantrum. We have to redirect. We have to have some distractors in there, and we have to modify those behaviors. Well, same as these, 30 and 40 something year old adults, all we are is 5-year-olds with bigger money problems. So stop having a tantrum, figure it out, follow this advice. Once you have your $3,000 in there, your very next goal is to have 3 months of your housing cost, okay? So not just your mortgage or your rent, but what it also would take to keep the water and electricity on as well. I want you to have 3 months worth of that set aside in this account. Once you hit that for this separate savings account that you are funneling 10% of your income to and any extra money that might come your way, now you can start chasing after your big goals. Do you want to become a homeowner? Work towards saving up 3% of that purchase price of the home. You want to start a business? Start creating a business plan now and start understanding how much money you have to have in the bank in order to take that leap and start becoming an entrepreneur. What other big plans do you have? Do you want to travel the world? Please don't put that on credit cards where it's going to cost you so much more money and interest. I want you to start saving with a travel fund. And so find out what that is. Do you need $3,000 every year to go to your destinations that you want to have? Then go ahead and start setting aside that money on a monthly basis aside from your 10% that you've got in your savings account that's going. Those are for other things. And that's what's so stinking hard about savings. Would you agree? We have to save for all different kinds of things. We have to save for our Christmas gifts. We have to save for our travel fund. We have to save for our emergency fund. We have to save for, the kids' braces, for college, for retirement. It goes all different ways. Have you ever heard of the 50, 30, 20 rule? I'm going to make a video on that, and I will make sure that I share that with you here shortly. It's a really simple way to have as a goal for your costs in your life to live off of, where you've got 50% going to the necessities in your life, 30% going towards the goals, your retirement, your savings, the other kinds of things, and then 20% for miscellaneous fun stuff that we got to have in our life. We've got to reward ourselves. So here's the thing I want to leave you with. Every time you hit your goals, whether it's your goal of slicing $200 out of your spending every single month, to put $200 extra into your savings, to pay off a credit card, to have that $1,000, that $3,000, that 3 months worth of your housing costs in an account, you have to celebrate. You have to honor yourself with a win, or otherwise you're going to go, well, this is boring and this feels like work. You have to celebrate it. So start creating some milestones and start attaching a celebration to it. Nothing is more exciting than hitting a really big goal, but then honoring yourself with a celebration and making sure that other people are helping you along the way. Having an accountability partner is amazing. So share it with somebody that will encourage you, but also hold your feet to the fire a little bit, if you know what I mean, and encourage you. And maybe kind of like if you are making some mistakes in your behavior modification. So maybe you went out on a splurge and spent $300 on a purse instead of having $300 in that purse. You want somebody that's going to say, hey, Kristi, is this the best decision for you to help you accomplish your goals? Because a lot of times our spending, it is emotional. It's where we're at in our headspace at the moment. And I promise you, if you are one of those people that go out shopping because it helps fulfill something for you, as fast as you spent that money is as fast as that instant gratification will leave you. And you're still going to have that emptiness inside of you. So I want to encourage you, find a different way, create a distractor, right? If you go, one of the ladies had said she goes to the dollar store and she winds up dropping $60. And I said, well, if you left your credit card at home and you literally had $21 of cash in your purse, you're only going to buy 20 items, leaving enough for tax. Am I right? And she said, yeah. I said, would you be more selective on what you spent money on? She said, yeah. Okay. Set some rules up for yourself and then honor yourself with following through with what you said was important to you, and then celebrate that success because you followed through with what you said was important to you. And it feels good when you can honor yourself that way. I would kick myself all the time because I said I was going to do something and then I didn't. And I'm like, there you go again, Kristi, letting yourself down. Who else are you letting down in your life? That talk has got to go. Get it out of your space. All right. So that's about the amount of time that I have right now, and I don't want to bore you. I don't want to lose you. So please, in the comments, tell me what your biggest takeaway was. Tell me what your next action step is. Tell me what you're going to implement first, and I hope it's that 10% savings, but if you've already got that working in your life, tell me what you're going to do next. I want to celebrate. I want to encourage. I'll be your accountability partner if you need it. But I want to say, let's get into action in this new year and make big things happen for our lives. And it starts with taking action, modifying our behaviors, even if it's just a little tiny tweak. A tiny little effort will get you that much closer. How do you eat an elephant? One bite at a time, baby. Thanks for being with me. And I hope this brings you some value. Let me know what your favorite takeaways were so I know how to make some other videos based off of this and be of even more help to you. So thanks for watching and stay well, my friends.